Germany's Frankfurt, AP, Russia's oil export prices are being capped by Western nations in an effort to reduce the revenue from fossil fuels that Moscow receives to fund its military, budget, and invasion of Ukraine. On December 5, when the European Union will impose a boycott on the majority of Russian oil, specifically, its crude that is transported by sea, the cap is scheduled to go into force. The price ceiling was still being discussed by the EU, as concerns about lost supply from the boycott compete with worries about weaker demand from a weakening global economy. The dual measures could have an ambiguous impact on the price of oil. How would it work and what is the price cap? Together with other group of 7 allies, U.S. Treasury Secretary Janet Yellen recommended the limitation as a strategy to keep Russian oil flowing to the world economy but limiting Russia's earnings. The intention is to harm Moscow's finances while preventing a significant increase in oil prices if Russia's oil is abruptly removed from the world market. How would oil continue to drive the global economy? The EU and UK imposed the insurance ban in earlier rounds of sanctions, and if it were universally enforced, it could remove so much Russian crude from the market that oil prices would soar, the economies of the West would suffer, and Russia would earn more money from the oil it is still able to export in defiance of the embargo. The second largest oil producer in the world, Russia, has already redirected a large portion of its supply to India, China, and other Asian nations at reduced costs after Western consumers abandoned it even before the EU ban. After the EU ban takes effect, it is crucial for the global crude markets that Russian oil still finds markets to be sold, he continued. If that didn't happen, oil prices would soar worldwide. What impact would various capital rates have? Russia might be able to continue selling oil while keeping its revenues at their current levels with a cap of between $65 and $70 per barrel. Russian oil is currently selling for about $63 per barrel, which is significantly less than the global Brent benchmark. It would be challenging for Russia to balance its state budget at a lower cap of $50 per barrel, as Moscow is thought to need $60 to $70 per barrel to achieve its alleged fiscal break-even. What will happen if Russia and other countries do not agree? Russia has declared that it will not adhere to a cap and that it will stop supplying nations that do. That reaction might be more likely to be elicited by a lower cap of about $50, or Russia might stop sending the last of its natural gas to Europe. China and India might not agree to the cap, though China may create its own insurance firms to take the place of those that the United States, the United Kingdom, and Europe have barred. According to Gallimberti, China and India already receive discounted oil and might not want to annoy Russia. In order to get around the embargo, Russia may also use strategies like shifting oil from ship to hide its origins. Therefore, it is uncertain what impact the cap would have. Where does the EU embargo stand? The EU embargo may have its greatest effect not on December 5, when Europe finds new suppliers and Russian barrels are rerouted, but on February 5, when Europe imposes an additional ban on products made in oil refineries, such as diesel fuel. Europe will need to rely on substitute supplies from the United States, the Middle East, and India. There will be a shortfall, which will lead to very high prices, predicted Gallimberti.